I'm very honored to have with me today 4 accomplished and distinguished speakers. First, Vicky Saporta. Vicky, you're the Executive Director for Markets at the Bank of England. You held several senior positions in central banking, including banking supervision, monetary policy, financial stability during your career at the Bank of England. You have a PhD in economics from the University of Cambridge. Nicolas Pillet is Group Treasurer at BNP Paribas. His previous roles include Chief Operating Officer of BNP Paribas Investment Banking in Hong Kong, General Manager of BNP Paribas branch in Japan. You graduated from École Polytechnique and École Nationale Supérieure des Mines de Paris. Sören Radde, you're the head of European Economic Research at Point72, a hedge fund. Prior to joining Point72, you were a senior European economist at Goldman Sachs, and you spent over 5 years at the ECB, so welcome back. Sören holds a PhD in economics from the Technical University of Berlin. Loubna Moudanib, you're a senior credit analyst at Vanguard. Previously, you worked at the Financial Services Authority in the UK, and before that, in Société Générale's rating advisory team. And you hold a master's in management and finance from a French business school. And Loubna is also a member of the Bond Market Committee of the ECB. So let us start, yeah? As a start, after some housekeeping remarks, I'll give the floor to all of you to kick off. But please ensure, and it's my plea, that you stick strictly to the time allocated. We have a wonderful countdown here, yeah? And in popular demand was to give a general disclaimer for this panel that the views expressed by the panelists are their own and not those of their respective institutions. And that applies maybe also to me. So let's start. The first round is about a topic that has really dominated, I think, today's and yesterday's discussion, which is the regime shift in liquidity availability. So as excess liquidity becomes less abundant, what are the key elements that central banks need to get right to ensure a smooth transition from the abundant liquidity regime for financial markets and for banks' funding and liquidity? So let's start with Sören.
Thank you very much, Imène. Thanks for having me on the panel. And let me start off by congratulating you on a really excellent conference. And thank you for bringing diverse perspectives on the subjects that were discussed over the past few days as well to the fore. On that, I'm going to take on my economist hat and probably pick up on some things that Isabel said yesterday in her speech. So what's the red thread really that runs through the transition of an abundant to ample, less ample liquidity regime in the ECB? It's really the desire to transition to a demand-driven system of managing excess reserves, right? Now, I entirely see the theoretical appeal of that approach. You've got banks that come to the operations, you anchor money market rates in your corridor by elastically supplying reserves, and banks reveal endogenously the required amount of reserves required to do so. And through that, you ensure a smooth transition of monetary policy. Now, in practice, I fear that will be a lot harder than it sounds in theory. So what are a couple of issues that I would highlight? One is you need a signal of reserve scarcity either on the price side or on the quantity side. Let's talk about Esther. Currently, Esther is 6.9 basis points below the DFR. If I look at the spread absorption rate, reabsorption rate, that's about 2 basis points per trillion of liquidity drain. That gets us to something like 6 basis points ester DFR spread by the end of next year. Now I'm thinking back to the charts you showed yesterday, Isabel. There was one chart, liquidity, excess liquidity time series with projection into the future and a band. That band was sort of determined by where excess demand or scarcity might kick in. And so if I remember correctly, as of the middle of next year, we might be in a regime, according to your scenarios, of excess reserve scarcity. At that point, ester is not going to signal that if what I just said is true, and we still have a negative spread below the DFR. So what about quantities, where you would focus next, right? So MRO take-up. I think this is the issue that was discussed last year, received a lot of attention this year as well. You've got fragmented distribution of reserves, 900 billion in Germany, 100 billion in Italy still. Are those going to be efficiently redistributed, and who turns up to the MRO? It's going to be the banks that have the least reserves, presumably weaker banks. There's a stigma issue, so what does it mean? Less take-up than you would like to see, and potentially funding in other markets, like repo, secured funding markets, that anchor the rates or push the rates above the MRO. So you might end up in a situation with ester below the corridor, repo rates, at least in some jurisdictions, above, and maybe not a perfect signal from volume. So that's maybe just to set the scene, the concerns that I think need to be addressed as we run up to that point.
Excellent. Nicolas, bank perspective.
Even if time is very tight, I cannot not thank you very much and all the ECB teams for this conference, which is really great. Even if it's a challenge to stand between you and lunch after such an insightful discussions. On stigma, maybe, it's a very delicate question. I think it's very important to have in mind that a very strong liquidity is what all our clients and counterparties are going to expect. And we cannot suffer any form of doubt, any form of question. It's not the conversations that we would expect to have. That's why there is, I would say, abundance of caution on that front. And I would say the bare minimum is to ensure that what we do has economic sense, and that's something that maybe you're going to elaborate, and that was also mentioned by John Williams this morning. Having said that, I want to insist that the facility, for example, MRO facility as it exists currently, even if not drawn, is very useful to the system because it's pushing banks to transform their assets, mortgage into self-retained covered bonds, consumer credits, or sometimes some types of SME credits into self-retained securitizations that have to be ready to be used for this facility. And it's very virtuous because it provides a buffer for each individual bank and for the system as a whole with basically no cost. The third point I would like to touch upon is to take into account regulations and market structure. I think in Europe there is a very big need for more financing, and it happens that in Europe non-financial corporates typically are much more dependent on bank financing than they are in the US. The order of magnitude, I think, is 32% of GDP in Europe is bank financing to non-financial versus 7% of GDP in the US. And the regulation is such that to provide additional loan, it means you need to sterilize part of your liquidity. Each time you provide 100 of loan, of course, you will create deposits, so you will have deposits, but because you have deposits, regulation, LCR regulation, force you to assume that there is a leakage on those deposits and that you have to sterilize part of that liquidity. So we need to take into account the specificities of the business model and have a forward-looking perspective on that. Last one is that obviously, as you mentioned, we need to monitor very closely the repo market, and that's probably where Victoria will go. And you've published very insightful papers on that.
So, Vicky.
So my perspective is obviously as the central banker on this panel, and I do think that a lot of central banks, certainly the Bank of England, the ECB, the Fed, but a number of others, are facing very similar issues in the sense that we're trying to do this quantitative normalization in an environment that is extremely different to the environment when we last thought we were normalized, which was before the GFC. And the environment is extremely different for a number of reasons. One reason is regulation is very different, and we've talked about that a lot in this conference. The second reason is the market structure is very different, and the two things might be related because regulation has contributed to the difference in market structure, but it's not only because of regulation. So non-banks, even in Europe, have, and in the UK, have a much more important role than they used to have before. And the third reason is relative to the pre-GFC environment, there is an abundance of government debt obligations due to much more increased issuance. So we have switched from a world of, if during our QE days, where the early QE days in particular, of the GFC, where we introduced injected reserves, but there wasn't that much collateral, so there was reserves abundance and collateral scarcity, to collateral abundance and reserve scarcity. And this is also a very important thing to keep in mind when we're looking at the repo market and at the unsecured market, and the two are connected. I've published a paper today trying to explain how I think these dynamics in a qualitative manner with some data, but it's not a model, explain the UK circumstances at the moment and link them back to the operating framework. In terms of, we, like the ECB, want to have a demand-driven operating framework when we totally normalize. Our framework is also going to be repo-led. That is, we're going to be supplying the structural, not only the marginal, but the structural bit of the reserves through what the ECB calls refinancing operations. We call repo operations. And therefore, for us, it's incredibly important, almost kind of fundamental or existential, to have destigmatized facilities in order to be able to do that. At the moment, we have 2 weekly facilities. They both settle on a Thursday, market-wide facilities. We have been very pleased that they both seem to be entirely destigmatized now, and they've been taken up. They're weekly. We also have bilateral facilities that are daily and settle at T+0, but it's the weekly operations that have been used more at this particular stage. We are going to be having bumps in the road, and we will have to learn by doing. Some of these bumps are also being driven by the pressures that exist in the repo markets, which are related to what I've described earlier, the collateral abundance, regulatory reserves draining, if you want, triangle, which are putting pressure on repo rates, which we see in quarter ends, month ends, and Canadian year ends, which, like in the US, are important for us. And we saw one last week in the UK. Repo rates went above 40 basis points. Our facilities were taken up at record levels, and they went down. And banks should be prepared for these types of incidents as we go along the way. Thank you.
Excellent. You set the scene perfectly. So now let's go to a topic that was abundantly discussed from the theoretical side at the previous session, but we're going to ask the people that live through that every day, what are the dynamics between banks and non-banks in money markets? And should non-banks be seen as competitors to traditional banks or as complements? And we're going to start with Loubna.
Thank you, Imène. So as we've been hearing during the conference with central banks' balance sheet normalizing and shift in market structure, non-bank entities are definitely rising in importance, particularly money market funds that have become structurally embedded into short-term funding, providing not only liquidity transformation, but also collateral efficiency. So I would definitely see them as a complement to the banking system, as there is an increasing need for liquidity. So let me focus on the investor demand side. So after exceptional years of investor demand for money market product amidst rising rates and flight for safety, the flows have been normalizing year to date, but remain strong. So they are on the institutional side, they were at almost $166 billion until the end of September, bringing the total asset under management industry for Europe to 2.5 trillion USD. And an interesting trend that we've been observing is the growing interest in this cash-like exposure into an ETF wrappers. So indeed, the European money market ETF category grew from $3 billion just 3 years ago to $32 billion at the end of October. So definitely tremendous growth there. And we've seen 9 billion of inflows year to date. And this demand has been not only driven by retail investors, but also intermediaries. And it has been dominated by synthetic overnight products, but we've seen the first cash ETF product launch late last year, which have been generating nice inflows so far. And looking ahead, as we've been discussing, that liquidity will continue to decrease, we still think that there is a huge potential coming from retail investor side. I mean, the European money market landscape, as you know, is still very much institutionally focused. And as you said, Christophe, like big, Nicolas, sorry. Big companies with cash reserves looking for reserve management, contrary to the US, where there is a strong culture of US money market product investing for households. So we're working on client education that cash doesn't have to be cash by putting your money in investment products. You benefit from dedicated portfolio management, capital preservation, diversification, and sorry, Nicolas, but providing an improved rate of return over bank's deposits. So just to give you an order of magnitude, we run some numbers using OECD data as of the end of 2024. And we find that for European Union countries, if they were to allocate the excess cash that they have over investment products, a simple reallocation of just 10% of that cash would provide potential liquidity of 660 billion euros. So that's a pretty significant amount. And I'm not saying that everything will go to money market, but it's a natural potential reshifting of that liquidity. And because we are in Frankfurt, I have to mention that the biggest cash saver are German investors, still 40% invested in cash. So look at your bank accounts. And conscious of the time, I will leave it there just with one message that we've seen very strong demand for Euro money market products, and we expect it to continue in the year ahead.
Thanks, Loubna. And you said, I think, two buzzwords. One is that there is innovation in money markets, also in products. And the second thing is money-like assets, and we'll be coming back to that in the third session. So, Nicolas, competitor or complements?
Well, first I would like to say that innovation and competition is good in general, and we are, of course, favorable to that. The shift in participants is obviously affecting the dynamics. And individuals' preferences are not necessarily the same depending on the geographies. Yeah. Capital market structure is also very important, and again, regulations. I would tend to answer that we are complementary when we think of all the secured markets. In fact, the regulations are strictly limiting the bank's appetite, and we play a crucial role in terms of market making And in these activities, hedge funds typically will have a risk appetite that banks are not allowed to have. And money market funds can be very useful also to distribute the liquidity. But of course, we can be also competitors in some segments for unsecured liquidity. And then it's very important to keep in mind that the bank's role in the economy is to channel unsecured liquidity and to have a kind of orderly maturity transformation and a supervised maturity transformation of those short-term deposits to be allowed to provide unsecured credit to the economy. But indeed, we can compete in many segments, especially for talents, by the way.
I'm sure that many of the hedge funds here appreciate the remark. So, Vicky, what's your view?
Yeah, I mean, I agree with what Nicolas said. I mean, from a central bank perspective, when you're thinking it from a sort of our roles, Imène, where we care a lot about market functioning, the monetary policy transmission and operating framework doing this. Certainly, and we heard it a lot, we saw the charts in Jeremy Stein's speech yesterday. Yeah. I mean, it's pretty clear that, that banks are able to warehouse, the repo desks of banks are able to warehouse less risk, so they take on less risk, and in particularly, they do not as much participate in basis trades, asset swap trades, or any other such arbitrage opportunities as they used to do. But they fund these activities through repo funding, and in so doing, they enable the transmission in the secured markets. But also from a market functioning perspective, I think the secured markets are crucial. So I would agree that they're complementary in that sense, but also I would agree on your comment on the unsecured market. I mean, for us as policymakers, I think it is quite important to think about the financial stability implications of all of this. Thanks.
Thank you very much. Would you like any of you to react to what was said on this bank, non-bank divide? No pressure.
I mean, all I can say is, well, you're looking at me. No. Compliments would be the view. For the most part, but I think I share the remarks that banks have capital cost constraints related to regulation, and so there's probably more demand for intermediation than can be satisfied because there are constraints.
Absolutely. So now we're going to shift to a topic that has been agitating, I think, the policy circles and probably also the market circles in the past few months. And that's the really transformational change that we're about to experience in finance. So, future of finance, future of money, and the rise of tokenization, and more particularly different forms of money in the financial system. And this has first of all, I think there's really a need to define what are we talking about, yeah? I heard a lot of confusion between different kinds of tokenized assets, and we trust that this panel will enlighten a little bit all this landscape that in practice for us central bankers has potentially a profound impact on many of our central banking functions, yeah, on monetary policy transmission, on monetary policy implementation, of course on payments, on financial stability, on supervision, and I'm probably forgetting, geopolitics and basically international role of currencies. So you We're going to start with Vicky, who really has the challenge, but I know she can do that, to give us the landscape here and how we should, from a conceptual perspective, think about that. And then we'll go to each of you, and we'll start with Sören, okay, Loubna, and then Nicolas, to give us your top-of-mind thoughts about this transformation and its implications, and maybe your top-of-mind concerns, and keep it to 2 minutes each. Vicky has a little bit longer.
No pressure. So let us think about, before digitalization and tokenization, about what is money. So money is the banknotes in your pocket or in your physical wallet. The deposits banks have with the central bank, which is a thing called reserves, or the deposits other institutions might have with the central bank. We heard of an example earlier, which is on reserves. And then is commercial bank money, which is the money that is the deposit that you have with your commercial bank. So what is the common thing about these forms of money? And one that is central in how to think about digitalization and central to the central bank's raison d'etre is the singleness, is what we call in the Bank of England the singleness of money. That the money, that the note that you have in your pocket, the money that you have the deposit that you have in Bank A, and the reserves that your bank have with your central bank are totally exchangeable and they have the same value. Now, what is digital tokenized money is the digital representation of money that are issued, recorded, and transferred on a programmable platform. So at the moment, there are three main forms of these tokenized money emerging globally: central bank digital currencies, tokenized commercial bank deposits, so the tokenized form of the commercial bank deposits. Central bank digital currencies are the tokenized forms of having your notes in your pocket. And stable coins are privately issued digital tokens, typically hosted by blockchains, but not necessarily, that aim to maintain a stable value by being backed with assets denominated in sovereign currency, which is a form of money. So effectively, they're tokenized representations of what we already have that can sit alongside the other forms.
Exactly.
Now, how can they work? Well, the fundamental thing is that they need to provide singleness. Now, CBDC, given that it's issued by a central bank, should provide singleness. The tokenized deposits are similar to commercial banks. So then the question is, if you have a systemic stablecoin, which we don't have at the moment, what makes it, what can provide the singleness? And the bank issued the Bank of England, issued a consultation paper back in 2023, which we got lots of comments on, and we're currently reviewing, and we're going to publish another one on Monday, so watch this space, about how to provide the singleness. In our first consultation paper, we said that a systemic stablecoin, to be totally exchangeable with the other forms of money, it needs to be 100% backed up by unremunerated reserves. This was, we got a lot of pushback about the viability of this business model. So what we are now going to propose is, yes, it is going to be backed by a portion of central bank reserves, and as a result, the systemic stablecoins need to have unremunerated reserve accounts with us. But the rest will be, they could have short-term government debt. But importantly, they will have access to master accounts with the Bank of England in order to do that. And that is also for financial stability reasons, which is an explicit objective of the bank, but an implicit objective of many central banks, so to reduce interconnectedness of this form of money to holding the liquid form of money in commercial banks, because we saw an example of the result of this interconnectedness in March 2023, when a US dollar coin lost its peg to the par value to the dollar because its bank failed. So that's an example of interconnectedness. But also to the extent that systemic stablecoins are going to be competing with the medium of exchange or payments function of banks who do lots of functions, but one of them is the payments function, then you don't have them to rely on their competitors if they are systemic stablecoins. So that is the way that we think about this particular form of digital money.
Excellent, and we look forward to the paper published on Monday. We hold our breath. So, Sören.
Thanks very much. So 2 minutes, okay. I'm by all means not a crypto expert. I'm an economist and a German. That makes me naturally cautious. So if I see projections that we're going from 300 billion stablecoin circulation at the moment to 1.5, 2 trillion over the next 5 years, maybe, but I would put quite wide error bands around that. Now, the one exception I can see from an economist's perspective is, where are stablecoins really providing value? Cross-border payments, right? So that's a natural habitat. They're resolving a problem at lower cost and providing a service that we don't have at the moment. No instantaneous payments. Okay, so if that is maybe the natural habitat I would see as an economist, that's where I would expect the proliferation and the penetration of stablecoin. And now how do I link that back to the ECB? The link is the following. I think it's quite clear that the current US administration intends to use stablecoin as an international medium, dollar-backed international medium, to foster dollar dominance as a reserve asset. So you could imagine stablecoins as a reserve asset, particularly in jurisdictions that have a lot of currency volatility. It has the cross-border payment function. It has probably a function in terms of invoicing. And so it fosters that role for the US dollar. And if I think of sort of a missing piece in that puzzle that is starting to shape up in the euro area, it is that. Where is the European competitor to this specific US dollar-backed stablecoin as an international medium of reserve holdings or payments? The digital euro will unfortunately, at least the way it's conceived now, not play that role. It's accessible only for euro area residents, and it will not, as far as I understand it, satisfy sort of that nature of an international payment medium. So if I had to think of a sort of missing puzzle, it's that. And I can see I'm still on time, so I'm going to hand over now.
But of course, it's all about differences of approach to money, central bank money, commercial bank money, across jurisdictions. Yeah, but I completely see the point. Loubna.
Thank you, and thanks very much, Vicky, for a very comprehensive update of a very vast market. First of all, I just wanted to agree with your point on the dollar reserve assets. And actually, the numbers that you mentioned in terms of growth, obviously, it's a lot of buzzwords around where are we going, where are we headed. But when you look at where most of the growth has been, it has been mostly in emerging markets, where they wanted this dollar stability rather than the volatility of their own effects. Now, when more traditional asset managers have been launching tokenized product, it has usually been in complex form and very high management fees. So we're still at the very early, I mean, some of the benefits are clear, but we're still at the very onset of that growth.
So you mean tokenized money market funds, for example?
Yes, but tokenized market, I think I'm more talking about other type of tokenized assets, but tokenized money market fund actually has been an interesting one because you still can combine the liquidity and the safety of the traditional money market, but then with the efficiency and accessibility of a blockchain technology. Yeah. So effectively for investors, it means that the potential for instant subscription and redemption, 24 hours, 7 days access, and improved transparency over your underlying holdings.
So in a way, it makes it also very similar to an ETF. I mean, you basically have money on demand. Yes. You no longer have the net asset value concept, no?
Yes, so I think but we're still at the very, asset management industry is still testing the use cases, but that has been definitely an interesting one to watch. I think you said to focus on 2 minutes, and the key top of mind, obviously, as a bank analyst, key top of mind is what does it mean for deposits going forward, and how fast, I mean, obviously that's an advantage for client, but what does it mean for financial stability in terms of bank runs, and also, I mean, European banks are still very much deposit funded. I think it's like 47% of their funding structure. So what does it mean if we go more towards that type of assets? I think one thing that we didn't mention and is important to note is that stable coins cannot pay a yield. That has been prohibited by European regulation, that has been prohibited by the Genius Act as well, although there have been some loopholes in the US. So in that sense, they don't necessarily provide direct competitions to the banks. But one thing on the European banking space is that they haven't just sat there, they like providing some defensive strategies. We've seen last month a consortium of 9 European large banks creating their own stable coins under the micro
Mika?
Thank you. That's Mika. I was wondering what was the MiCA regulation. Some Japanese banks have been doing the same thing, and Fiserv in the US for regional banks as well. So we're seeing more and more movement. But as I said in the intro, it's still nascent, but definitely something that, one, we need to be aware of and continue to educate ourselves as we are doing today, and two, be very aware of potential risk because they are plentiful, most notably for financial stability, as you mentioned, Victoria.
Thanks for highlighting, I mean, the impact on the volatility of bank deposits, and both, I think, Isabel and John's speech talked to the fact that there would be new drivers to reserve demand, and that somehow we need to make our frameworks fit for these drivers, hence keeping the flexibility and the sufficiency of reserves. So, Nicolas, you're on the spot for bank deposits and other things.
As I said, innovation is very stimulating. It's still very early stage, very fluid in terms of the use cases. Yes. And I think it's the nature of research, and you are more familiar with research than I am probably, but you don't necessarily, you will find things along the way, and you need to be ready to adapt, and it's very important to take part of all these discussions and to be really within this innovation mind. Having said that, the reaction, I think, shall not be to throw away too quickly a system that is very resilient, a two-tier system. And to name a couple of reasons, the first one would be anti-money laundering and all the financial security that this provides. I think it is very important. The second reason would be what I mentioned earlier about the necessity to transform the deposits into unsecured credits to the economy. It's absolutely fundamental. And a stable coin that would access a central bank would probably become a store of value and sterilize that money. So the impact for the economy eventually should be taken into account. My last comment would be on wholesale CBDC. I think it's very critical. It's very important. We also take part of all the experimentations that the ECB is conducting. And it's very important to build the infrastructure to have a competitive tokenized ecosystem that would be valid for every instrument, including the assets, and be able to pledge those assets as collateral, etc.
Yeah, let me stress that. I think that tokenized forms of central bank money are really a key enabler to the future of financial markets in tokenized forms. It's money markets, it's bond markets, yeah. And clearly at the ECB, we're very committed to provide that as well within a time frame that allows to match the pace of financial innovation we're experiencing. So mission accomplished. But now we turn to the audience, and we have 15 to 20 minutes, depending how long you want to discuss, to take questions. Oh, I knew. Anne-Marie.
Thank you very much. Super panel. I appreciate all your insights. Could I just ask a question to Vicky? And thank you for trailing the DP coming on Monday. So I'm interested in the views, particularly of you and maybe any others who want to comment on having backstops for central banks. I think it's been trailed that the Bank of England is considering access to balance sheet or facilities for stablecoins. And it's just to understand your thinking on the guardrails that you'd put around that. Who would have access? Would it be banks and non-banks? Would you differentiate between different types of stablecoin issuers? Some are issued by banks, some are not. And what circumstances you might see something like that being activated, while appreciating you're in the information discovery phase of a DP, not activating new policies. Thanks.
Yes, thanks very much, Anne-Marie, and nice to see you again. We used to work together many years ago. So So in the 2023 sort of vision of systemic stablecoin, there would have been no need for a lender of last resort function, because the coins would have been backed 100% by central bank reserves. For those who have lived in the UK, not dissimilar to what sort of Scottish or Irish notes are. Because the UK is actually 4 countries. But in this version, because we are going to be allowing government, some short-term government debt, there is always sort of interest rate risk. So there is always the possibility that the coin is not backed up 100%. So what do you do for that? So under the assumption that, of course, the stablecoin provider is solvent, because of course we don't do lender of last resort to insolvent institutions, then we are considering, and this is going to be in the CP, in the consultation paper on Monday, but it has already been trailed in one of our deputy governor's speeches. We are considering, so my area of the bank is considering a lender of last resort facility given this development. In terms of who can be a stablecoin provider, I mean, it can be a non-bank. Yeah. So this is absolutely clear. In the same time, back in I think 2023, I was still in my previous role. We issued a letter explaining how we perceived tokenized deposits, and tokenized deposits are also. We would encourage banks to develop tokenized deposits, and of course, banks do already benefit from a central bank lender of last resort system. and indeed resolution systems that we may also need to think about in terms of non-bank stable coins.
Yeah.
Thanks.
So basically, stablecoins and tokenized deposits are not mutually exclusive.
Indeed, and I mean, I'm expecting to see a very sort of dynamic, competitive environment in these developments, which should encourage innovation, but obviously will have implications for the central bank balance sheet, as you were saying, Imène. And if I may add, because I totally agree with the point that you made earlier, I think for wholesale settlement, which is of course the settlement you have for the settlement of transactions in core markets, there being able to do that in central bank money in digital form or not is quite crucial for financial stability.
Mm-hmm. Exactly. Would you like to react? Not at this point, Nicolas.
I can jump in. I think it's risky to discuss when something doesn't yet exist about one specific feature. I think it's very important to think of the objectives of what we are trying to achieve before deciding ex ante that if someone builds something that becomes systemic, be reassured you will have access to this and that. I think, and it's complex, it's fluid, but it's very important to think of the overall system instead of a specific feature separately. That would be my only comment.
Also because Vicky said, like, the systemic character or not of all of this matters for the central bank, obviously.
And matters for the impact on the overall economy, what you are going to do. And by stating something on a specific feature for something that does not yet exist, you are strongly shaping the development of some type of activities, and it will be very difficult if you realize later on that the impact is not what you wanted. You will just be not be able, in fact, to change the course, because it will be very difficult to change that public statement.
And of course, moral hazard potentially as well. Let me take other questions. Yes, please. And then we go to...
Thank you, Imène. Ilya Lingorsky, Bulgarian. Hello?
We can hear you up here.
Thank you, Imène. Ilya Lingorsky, Bulgarian National Bank. Question to Sören maybe, but all the others. Picking on what Sören said about dollar dominance, intentions or views with regard to stablecoins. How do you see the evolution of the euro-dollar market with tokenization, and also perhaps the impact on on American short-term debt issuance, given the fact that through tokenization you may access another few $1 trillion, which are sitting idly or semi-idly globally as liquidity, particularly given the fact that the technology will allow you now at individual level to, offer products which are, creating new demand for US debt.
So maybe on the spillovers, you want Sören to take it?
Yeah, absolutely. I can make a start. So I think you're raising an important issue there in terms of other features or side effects, intended or otherwise, that an expansion of stablecoin may have. So, among the numbers that I quoted earlier, going from 300 billion to 1.5 to 2 trillion over the next 5 years, around $500 billion of that growth, according to these estimates, will be driven by idle non-dollar utility non-dollar liquidity, as you called it. Right, so this would be sort of the minimum inflow, if you will, that would have to be backed by short-dated liquidity, short-dated assets, high-quality assets. Amongst others, I think according to the Genius Act, treasuries with up to 93 days residual maturity. These estimates also, are for domestic channels, etc. So additional take-up that could increase treasury demand by 1 trillion. In a 6 trillion market. That is not insignificant. with a very, very heavy steer towards the short end, as I just said. Now, you would expect that that has implications, or could have implications, for issuance patterns and for the curve. Right? So I think that is something to take seriously and to think about. My perception, but again, this is very much an outsider's perspective, is that that is probably a desired feature rather than something that raises concerns.
Yeah. Professor Allen, yeah.
So one of the important aspects of the whole crypto revolution is that people can sit at their computer and access products anywhere around the world and make investments and so on. And one of the issues about these regulations is how easy they are to get around. So at the moment we have the Genius Act and similar legislation in Europe that you can't pay interest on stable coins. But what that means is that people that actually generate stable coins are making huge amounts of money because they're able to cream off the whole interest. Now, in the long run, that's probably not stable internationally because some jurisdiction will say, okay, well, we'll let you pay 1% or 2%, and we'll still have enough restrictions so that you pretty much guaranteed that you have a payment. And it's this international competition, which I think is key, that you can't actually control outside your jurisdiction what people are paying. And I think that that's the nature of the competition that is now there and which is important. And it used to be difficult to go cross-border and to take money and invest it elsewhere. And the crypto revolution is really about doing it at your desk at home or wherever, and doing it 24/7 and having instant settlement. And that's the nature of the competition that standard financial institutions face going forward. And I think, you know, it's interesting whether the numbers you're quoting, Sören, include that kind of competition or not.
Yeah, and just to add, I mean, these stablecoin issuers, they operate globally. Yeah, so basically they can be incorporated under different regulation in different jurisdictions. I mean, we do have that with Circle between the US and Europe. And then you wonder, you know, what's really backing the stablecoin, yeah? Vicky.
Yeah, well, I do agree with Franklin on this point. And to be honest, regulatory fragmentation is a concern in this development. I mean, at the moment, I'm not so concerned about it in the developments at this point in time, T+0, because these stable coins are mainly used to settle transactions in crypto markets, which are not yet systemic. But once they start settling transactions in more systemic core markets, or once they gain such a size that they're systemic, then the issue of regulatory fragmentation really matters. And this is why in the past with banks, we have international standards to prevent what you described, which is a race to somewhere that might not be the optimum point from a sort of social welfare perspective.
Yeah. So let's go to Alain.
Thank you. To push further the previous questions is that Loubna said that there are similarities, commonalities between the MiCA and Jesus Act, which is true, but also in terms of the nature of the backing and the redemption, there are differences. And then to jump on the previous question, and this is more a question for you, Imène and Victoria, is that there will be spillover from the evolution in one jurisdiction to the other jurisdiction if you have this arbitrage between the nature of the backing and the redemption in one allowed in one jurisdiction and not elsewhere. So don't you think that two issues? Don't you think that first that force everyone to move at the same speed to adopt the stable coins and to have to limit this arbitrage? And the second question is that what about the central bank digital currency? Is there still a place?
Okay, so I'm going to separate that in two parts. The first part is what you said about the different backings, and then I'd appreciate to hear from Nicolas, Loubna, okay, because this has implication on the money markets, okay, the kind of weights that you have in the backing of the stable coins. And then your second question, I'm going to use my golden card, which is, this is a market panel. So we're going to keep it a market panel. And then I'll also give the floor to Isabelle, which I'm sure will have insights on all the issues we discussed. So, ladies first.
So, just precise exactly what you want me to answer, because I'm conscious of time. I want to make it very focused.
No, just to say, so if you want different regulation, mandate, different weights for bank deposits, potentially reserve, central bank reserve deposits, and T-bills, okay? So how is this going to impact, for example, how you transfer money from money market funds potentially to stable coins, yeah? And also it's going to, of course, impact through T-bills the entire construct of the money market.
Yeah, it's a good question, and obviously we're talking theoretically for the moment. But the key thing, I think, it's around the stability of these underlying assets. I think it has to be trusted, and going back to the singleness of money point, you want to make sure that this peg holds.
Doesn't break the back. It reminds you of something.
But in terms of how we're thinking about it longer term, I think at the moment institutionally we're still very much into the use case, so that there won't be like a strong answer or view that we have on the topic at the moment that we can share publicly.
But I would like to start by responding on the people behind their computer willing to do some things all the time. Well, not everybody is willing to do that, but it's possible. It's not necessarily a stable coin, and for many usage, if you effectively digitalize, there is work to be done on tokenizing the infrastructure.
Yeah.
But it is not necessarily, I mean, you can achieve that. And for clients of the real economy, large and small, it is largely achievable. That's the first point. Second, and you touched upon it, on the risk of depeg. For large transactions, it's very clear that you have zero tolerance
to that.
To that, and for that you need to develop the CBDC for the wholesale, and it's a collective effort that we are all doing. And then I think, Sören, you reminded the intention of the build-up of the stable coins, and it's very clear that for an individual who starts an issuer and can earn billions, it makes quickly a huge difference. But then what we want to do with that in each jurisdiction, it's extremely complex.
Yeah, Isabelle.
Just a very short question. So stablecoins seem like unremunerated stablecoins look like a money machine as long as interest rates are positive. So what happens when interest rates are negative?
Provocative question.
Joker. we suffered too much in that environment. No, but I mean, clearly, with positive interest rates, the people who are launching stable coins are probably, because I'm not in their minds, intending to invest the money they earn to build an ecosystem, because it's a race to effectively gain market share and build an ecosystem. But it's very fluid, and the economists maybe.
Well,
I'm not an economist.
The economist would think of, is there possibly an actor that maybe has not unlimited, but pretty deep pockets and loss-bearing capacity?
No.
And is that maybe sort of, no, but is that a substantive externality that warrants having a public version, a CBDC, rather than private? Because there are circumstances and states of the world where the private platforms and rails, whatever you may call them, break down. That doesn't mean, in my mind, that was actually my question, but I understand as a market panelist, I'm not allowed to ask this question of the policymakers in the room. But my question would be, why can't these things coexist? And why do we have such different perceptions of the importance of sovereignty of money here versus other jurisdictions? But I think you've given a good reason why they should coexist.
And maybe we can take advantage of the very international setting, because there are a lot of stable coins in dollar to ask what happens if the US dollar rates are negative.
Okay, so let me see. I think I'm going to stick to the time, because that's super important in this conference, and we've been doing quite well so far. So it's been a fascinating panel. Join me in congratulating the panelists. And now just a few concluding remarks. I'm going to shift here. That's easier. So thank you for all of you, of course, for joining us here. I think that we had a fascinating combination, actually, of insights, starting with Isabelle's opening remarks that, as I said yesterday, I think completely set the tone for this discussion. So thanks very much. Then session one provided fresh evidence on the demand and supply of reserves, and also lessons from interventions in corporate debt market. And let me say that I think for the ECB, the intervention on the commercial paper market is a bit of an example, indeed, of how you conduct market function intervention. Session two, repo markets, so basically going into role of the dollars, how also securities losses impact the dynamics, and the evolving role of collateral. Jeremy, where's Jeremy? Keynote yesterday, very stimulating on Treasury market function or dysfunction, actually, and how this raises new questions about central bank's lender of last resort, or market maker, I should say, of last resort, or both, yeah. And then session three, the global funding spillovers. I think that was fascinating on how cross-border linkages shape conditions, not only domestically, but also all over jurisdictions. And session four, Petra, really, I think, preparing the stage for my panel. So I have to thank you very, very much, and all the presenters and panelists. And last but not least, I mean, John, thank you very much for making the trip here, being here with us at the ECB. I think that your speech that was combining theory and practice was really perfect for this audience, yeah, which is basically combining policy insights, analytical insights, and markets, yeah. And you're the chair of the Markets Committee, our chair. So thanks a lot, yeah. And a word to my colleagues, first of all, for the poster presentations that I heard extremely positive feedback, and I'm sure you can agree with me on about providing fresh perspectives. And also, I do think that market functioning topics and especially money markets, interaction with the regulation, central bank policies, this is a little bit of an under-researched area. So our academics have done a great job for presenting papers and discussing them. But we have the new generation as well in central banks that is now heavily investing into this field. And I'm really very happy about that. And finally, of course, my panelists, thanks a million for the discussion. So I cannot, and we cannot leave this room without thanking all the people behind the scenes that have been tirelessly, I can tell you, for months, preparing this conference, and that have been attentive to every single detail of the conference. So join me in a big round of applause to them.